Investing in the stock market can feel like navigating a maze. There are so many factors that can influence a stock's price. It's easy to get overwhelmed. But don't worry, there's a powerful tool that can help you make sense of it all. Fundamental analysis. Fundamental analysis is like looking under the hood of a car before you buy it. Instead of focusing on short-term price movements, we're interested in the long-term health and potential of a business. We want to understand what makes a company tick. This involves examining a company's financial statements, considering the overall economic landscape, and understanding the dynamics of the industry in which the company operates. By carefully evaluating these factors, we can make more informed investment decisions. Think of it like being a detective. We're searching for clues that tell us if a company is fundamentally sound and poised for growth. The first stop on our fundamental analysis journey is the company's financial statements. These documents provide a snapshot of a company's financial health. They tell us how much money a company is making, how much it owes, and what assets it owns. The three most important financial statements are the income statement, the balance sheet, and the cash flow statement. The income statement tells us how much revenue a company generated, its expenses, and its net income. The balance sheet shows what a company owns, assets, and what it owes, liabilities. The cash flow statement tracks the movement of cash both in and out of the company. Imagine you're considering investing in a local bakery. You'd want to see if their sales are growing. Are they managing their costs? Do they have enough cash on hand to buy ingredients and pay their bakers? This is the type of information we can glean from a company's financial statements. By carefully analyzing these statements, we can get a clear picture of a company's profitability, its financial stability, and its ability to generate cash flow. While understanding a company's financials is crucial, it's equally important to consider the broader economic environment and industry-specific factors. Think of it this way: even the best ship can sink in a storm. Economic indicators such as interest rates, inflation, and GDP growth can have a significant impact on a company's performance. For instance, rising interest rates can make it more expensive for companies to borrow money, potentially impacting their expansion plans. Similarly, industry trends can create both opportunities and challenges. A rapidly growing industry might offer significant potential for companies operating within it. However, it can also lead to increased competition. Let's go back to our bakery example. If the price of flour skyrockets due to inflation, it will impact the bakery's profit margins. Similarly, if a new bakery opens across the street, it could impact sales. By considering these external factors, we can assess the potential risks and opportunities that a company faces. Now that we've explored the key components of fundamental analysis, let's see how it all comes together to help us make informed investment decisions. By carefully examining a company's financial statements, considering the economic landscape, and understanding the dynamics of its industry, we can develop a well-rounded view of its investment potential. We can identify companies that are undervalued by the market, meaning their stock price is lower than what their fundamentals suggest it should be. Remember, fundamental analysis is not about trying to predict short-term price movements. It's about identifying companies with strong underlying businesses that are well-positioned for long-term growth. It's like planting a seed and nurturing it over time. By using fundamental analysis, we're essentially becoming business analysts as much as we are investors. We're looking for companies that are built to last, with solid foundations and bright futures.